As of right now, the markets are closed for the weekend, and looking back at Friday's session on January 23, 2026, BigBear.ai Holdings Inc., trading under the ticker BBAI, closed at $5.81 per share. This represents a decline of 1.94% during the final trading day of the week, with the stock oscillating between an intraday high of $6.03 and a low of $5.74. While a 2% slide might seem like standard volatility for a small-cap AI play, there is a much deeper tension brewing beneath the surface of this closing figure. Most investors walked into 2026 expecting Big Bear to ride the coattails of the broader AI surge, much like the massive gains we've seen in Nvidia stock or even the steady climb of Apple stock. The reality, however, is that Big Bear is currently caught in a structural squeeze. Just this month, we saw the company finalize the conversion of $125 million in senior secured notes into equity. On paper, this is a massive win because it cleans up the balance sheet and removes a significant debt overhang. But the market's immediate reaction was a cold shower of dilution fears. It's the classic battle between long-term solvency and short-term share value, and right now, the short-term traders are the ones winning the argument. If you're looking at the big picture, the expectation was that Big Bear would finally emerge as the mini Palantir of the defense world. People want to see those high-margin, scalable software wins that made Palantir a darling of the individual brokerage accounts on platforms like Robinhood. Instead, the reality has been a series of lumpy government contracts and a revenue guidance cut that happened late last year, pulling expectations down to the $125 million to $140 million range. While the company is winning $13 million deals with the Department of Defense and partnering with the Kraft Group for supply chain logistics, the speed of execution isn't matching the AI at all costs hype that fueled the 2024 and 2025 rallies. This is where the curiosity loop starts. We're seeing a company that has effectively reset the story by eliminating debt, yet its stock is struggling to hold the $6 level. Why? Because the institutional activity suggests a pivot. Large-scale funds are no longer just buying anything with AI in the name. They're looking for path to profitability clarity, and that is exactly where Big Bear is currently being tested. When you open up your Robinhood app or check your SoFi Invest dashboard, it's easy to get lost in the daily noise of green and red candles. But look at the volume. On Friday, we saw over 86 million shares change hands. That's a lot of liquidity for a company with a $2.5 billion market cap. It tells us that despite the price dip, there is an intense battle for control. Institutional players like Vanguard and Susquehanna already hold decent stakes, but the recent executive share dispositions have left a bit of a sour taste in the mouths of retail investors. It's hard to tell a growth at all costs story when insiders are trimming, even if those sales are part of pre-planned 10b5-1 programs. This creates a psychological ceiling. The common ground among many self-investing enthusiasts is that Big Bear is a long-term winner because of its FedRAMP-first strategy. The deeper reality you have to face, though, is that being a government contractor is a slow, grueling business. It's not like selling a subscription to a consumer app. It's about navigating the bureaucratic maze of the Pentagon, and while Big Bear is good at it, the market's patience is wearing thin. Let's talk about the competition for a second. If you're looking for investment help on any of the popular investing sites, you'll see Big Bear compared to giants like IBM or Accenture, but that's not really the right comparison. Big Bear is fighting for the edge. Their partnership with T-Second to put AI on ruggedized hardware for military use is a clear signal that they are trying to move away from being just another data analytics firm. They want to be the brain inside the hardware that lives on the front lines. This is a high-stakes move. If it works, they become indispensable. If it doesn't, they're just another vendor in a crowded sea of AI startups. This tension is what makes the BBAI stock movement so fascinating to watch on the Fidelity mobile app or any interactive broker's platform. You're not just betting on code, you're betting on the future of autonomous warfare and logistics. The sentiment on the street is split right down the middle. You have firms like Cantor Fietier recently downgrading the stock to neutral, citing increased competition in the AI space. At the same time, H.C. Wainwright is sitting there with an $8 price target, telling investors to accumulate on the dips. It's a classic bull-bear tug-of-war. The bulls see the $450 million cash pile and the $376 million backlog as a safety net. They see a company that is finally unhandcuffed from its debt. The bears see a 20% year-over-year revenue decline in the most recent quarter and wonder if the AI surge already passed Big Bear by. This is the reality check. Big Bear isn't NVIDIA stock. It doesn't own the hardware, it provides the intelligence that runs on it. In a world where every company is claiming to have the best AI, Big Bear has to prove that its decision intelligence is actually superior in high-pressure, mission-critical environments. Comment below how many shares of BigBear.ai you currently hold, or if you're waiting for it to drop back into the $4 range before you even think about hitting that buy button. Looking at the business model, Big Bear operates in three main buckets: national security, supply chain, and digital identity. The national security side is the bread and butter. This is the Orion platform that helps the Joint Chiefs of Staff visualize global forces. It's the kind of high-level work that creates a moat because the security clearances and trust required to handle this data are immense. Then you have the digital identity side, like the Veriscan system at Nashville International Airport. This is where they have the best chance to scale in the private sector. If they can get facial recognition and passenger processing into 50 more airports, the revenue mix changes from unstable government contracts to steady commercial fees. That's the pivot everyone is waiting for. But until that happens, the stock is going to remain a slave to the macro environment and the latest defense budget headlines. If you're using Schwab Intelligent Portfolios or other robo-advisors, you probably won't see much BBAI in your holdings because it's still considered highly speculative. This is a stock for the active trader, the person who spends their time on the interactive broker's trading platform looking for inefficiencies. The volatility is the feature, not the bug. When you look at the 52-week range of $2.36 to $10.36, you realize that this stock has the potential to triple or lose half its value in a matter of months. That's the reality of small-cap AI in 2026. The initial hype has faded, and now we're in the show-me-the-money phase. Investors aren't buying the vision anymore, they're buying the execution. The macroeconomic pressures are another layer of the reality we have to deal with interest rates finally stabilizing but still at levels that make borrowing expensive for smaller firms. Big Bear's move to convert debt into equity was a survival tactic as much as a growth move. It protected them from the rising cost of capital. However, it also signaled that they weren't confident they could pay off that debt with organic cash flow in the near term. This is the nuance that many online investing blogs miss. They see debt-free and scream buy, but the cost of being debt-free was a significantly larger share count. Looking ahead to the next earnings date, which is tentatively set for March 5, 2026, the expectations are already being managed. Analysts are looking for a loss of about $0.05 per share. If Big Bear can come in with a surprise profit, even a tiny one, it could be the catalyst that finally breaks the stock out of its current range. But the reality is that they have to show that their recent acquisition of Ask Sage is actually contributing to the bottom line. Integration risk is real. When a small company buys another company for $250 million, there are always hiccups. If those hiccups show up in the Q4 report, we could see a revisit of the $4 levels. So, where does that leave us? The expectation is a slow, steady climb as AI becomes more integrated into the federal government. The reality is a volatile, news-driven stock that is currently being penalized for its dilution and its reliance on lumpy revenue cycles. If you're self-investing through a Fidelity brokerage or any other individual brokerage, you have to decide if you believe in the mini Palantir thesis. Are they building a platform that will eventually be the operating system for the U.S. military, or are they a collection of niche tools that will eventually be acquired for their talent and clearances? For those of you using a SoFi trading platform or the Robinhood app to play the short-term swings, the $5.75 level seems to be a key area of support. If it breaks below that, the next stop could be a lot lower. But if it holds and the market starts to rotate back into value AI names, Big Bear could easily test the $7 mark again. It's all about the narrative versus the numbers. Right now, the numbers are messy, but the narrative, debt-free, high-level defense contracts, and airport bio